Joining us now from Washington is economist and senior economics writer at the Wall Street Journal's Steve Moore. And Mr. Moore, thanks so much for joining us again here on Newsmax TV.
My pleasure.
Okay, a London fund manager has observed that U.S. economic data has recently fallen off of a cliff. Do you think that the U.S. economy is in a short-term correction or soft spot, or are we headed for more dire trouble and another recession?
You know, let's put it like this. Everything that Washington has done for the last 2.5 to 3 years since this recession started back in October of 2008, everything the U.S. government has done, in my opinion, has been exactly the wrong thing to do. We've had more and more spending. We've spent $2 trillion. We've had these massive increases in the printing presses in terms of how much money the Federal Reserve is churning out. We've had higher taxes. We've had Obamacare. We've had talk of all these pro-union policies, all these new regulations. They're strangling the U.S. economy. That's why, you know, this election in 2012 is so critically important for the future of our country. We can't continue as a nation to be the highest tax country, the country that has these strangling regulations, the country with the highest debt. Our public policies are completely out of whack, and they are working against growth, and they are working against jobs. So we need a dramatic 180-degree turn away from what Obama has done towards tax cuts, debt reduction, spending reforms, regulatory relief, and sound money. Those are the principles that Ronald Reagan taught us are what create a booming economy.
You recently wrote that if the Democrats get their way on taxes, the top combined tax rate would soar to 62%. How would this happen?
Well, first of all, a 62% tax rate should be very frightening to people. Now, the Democrats say, well, that would only apply to millionaires, but millionaires are the people in the highest income tax bracket in the country. About 2/3 of those people are small business owners, operators, and investors. They're the people who create the jobs. So if you're going to take 62 cents out of every dollar they earn, they're not going to have a lot of money left over to reinvest in the business, to reinvest in job creation. I think the American people intuitively understand that and realize how devastating that would be. What I did in my analysis in the Wall Street Journal was looked at the current tax rates, which are about 40%, and then looked at all the additional taxes that President Obama and Harry Reid and the Senate have been talking about. And let's not forget there are also many tax increases in the Obamacare legislation. That's one of the reasons that's such an abominable bill. But if you add up all the income tax surcharges, the millionaire taxes they want to have, the end of what we call the cap on the payroll tax, we are headed to a 60 to 62% tax rate. That compares with when Ronald Reagan left office, the highest tax rate in the United States was only 28%. This also comes at a time when most of the rest of the world is lowering their tax rates. The United States would be virtually the only country in the world that's raising rates. That's going to have a dramatically negative effect on our economy, and it's going to lead to jobs and capital and businesses being outsourced to other countries.
Steve, of all the potential or declared presidential candidates for the GOP, which one has the fiscal or economic policies that make the most sense to you?
Well, first of all, just about anyone's policies would be an improvement over this president's policies, because really everything Barack Obama has done on the economy, with very few exceptions, has actually hurt the economy. All the regulations, anti-drilling policies, so we don't have a energy independence policy, all of the tax increases, Obamacare, the pro-union things. I mean, you add all these things up and it's amazing that our economy is functioning at all. So just about any Republican who is running, of the 7 or 8 that have already thrown their names and hats in the ring, have a much more pro-growth policy. I think Mitt Romney talking about lower tax rates, as is Herman Cain, who wants a fair tax, a replacement of the income tax. I think that's fantastic. I think that if you look at what Governor Tim Pawlenty has been talking about, regulatory reform, getting government off the backs of businesses. All of those ideas are so important, and I really like what Michelle Bachmann, who is likely to throw her name into the ring. Michelle is talking about dramatically downsizing government, because every time the government spends a dollar, that's the dollar that comes out of the productive private sector. So I think Republicans tend to have very strong ideas about rebuilding this economy, and boy does it need to be rebuilt given how shaky this recovery has been and how deep the recession was.
Now, Fed Chairman Ben Bernanke thinks that the increase in inflation and pretty much anything now hurting the economy will be transitory. What's your take on that?
I think Ben Bernanke has been one of the real problems. I think the next president, whoever he or she might be, ought to replace Ben Bernanke as one of his or her first acts of office. Ben Bernanke has been running an extraordinarily inflationary monetary policy. Anyone watching this video who goes to the grocery store or the gas pump knows that our monetary policy is completely out of control, that inflation is here. If you look at what's happened to the price of gold, it's gone from $900 to $1,500 an ounce, and I think gold price is one of the best indications of inflation. The price of everything from butter to gasoline to bread to things that you buy at Walmart are all rising in price. And you know, Ronald Reagan taught us in the 1980s that you want a dollar that is strong and stable. And what we have right now is a currency that is weak and falling and unstable. And that is unsettling the economy. It's leading to investment leaving the United States. And if we stay on this course, we're at risk of losing the dollar being the world reserve currency. And that would be a devastating blow to the U.S. So we have to stop pretending that we can get out of this economic recession by printing money. That has never worked. It's never worked in the United States. It didn't work in Argentina, Bolivia, Mexico, Russia, all the other countries that have tried this. So we ought to change directions and get back to a stable currency that holds its value. A dollar, as Ronald Reagan used to say, that is as good as gold.
Steve, are we in for more quantitative easing from the Fed, and if so, when?
Well, you know, what the Fed has been doing for the last several months, called QE2, is injecting about $600 billion of paper money into the U.S. economy. That's one of the reasons we have creeping inflation right now. And the big issue is whether the Fed will have another massive injection of money later this summer. I certainly hope we don't. I think that all of this easy money has become like a narcotic for the U.S. economy. We're like drug addicts in this country, addicted to cheap money. And I think that's a fool's errand. And I think Ben Bernanke is really looking at, basically injecting more and more money into this economy. If you look at what's happened since 2008, we've doubled the supply of money in this U.S. economy. And when you print money, you don't create prosperity, you create inflation. And so I think Ben Bernanke is completely wrong in the way he has handled the economy. I think he's contributed to the weak economy and the weak expansion.
Now, the S&P Case-Shiller Home Price Index this week said home prices in 20 U.S. cities dropped in March to the lowest level since 2003, confirming a double dip in home prices across much of the nation and showing that housing does remain mired in a slump almost 2 years into the economic recovery. Do you think that we've hit a bottom in housing prices, or can they go much lower?
Well, I do think we're near a bottom in the housing market, and when you've got housing prices today that are as low as they were in 2002, that's telling us that we've had a massive meltdown in the housing market. And we've had, for the last 2 or 3 years, almost no new homes have been constructed. We're seeing a lot of people moving out of their houses and foreclosing on their loans, so there are a massive number of houses on the market. I actually think that we're close to the bottom on housing. I think actually real estate and housing is a pretty good buy right now, because if we get this economy moving again, housing will continue to rise. But if you look at what the United States government has done over the last 2 or 3 years, all of the interventions, Fannie Mae, Freddie Mac, the Federal Housing Administration, basically providing 100% guarantees to banks on repayment of these loans. If you look at the $8,000 new home buyer tax credit, that simply propped up the housing market temporarily, and as soon as that program ended, the housing market tumbled again. And worst of all has been this nearly $500 billion program run by the Obama administration of basically paying people with taxpayer money to pay their mortgages. These mortgage modification programs have had no positive effect on the housing market. They've simply required people like you and me to pay for other people's mortgages, which is completely unfair. It's financially unsound. And all that has happened, by the way, is when the program ends, those same people that the Obama administration has tried to help, they simply default on their mortgages later. So we've really helped no one. And what we've done is we've prevented the housing market from hitting a bottom, which is exactly the wrong thing to do. The market can't get better until it hits its bottom, and we can start to recover from what has now been a decade-long housing recession.
Steve, last question real quickly. What are the biggest bubble risks facing us today?
I think the big bubble in the U.S. economy right now is debt. And it's not homeowner debt, and it's not business debt, it is government debt. In fact, the tragedy of the U.S. economy over the last 2 years is that Americans have begun to repair their balance sheets. They're saving more. Our individual household saving rate has increased a lot in the last couple of years. The same thing with businesses. Businesses were way overly indebted and had too much leverage in 2007, which is one of the reasons the market collapsed and the housing market collapsed. But businesses' balance sheets look much better today. But guess which balance sheet looks like a disaster? Government balance sheets. And so when you ask where's the next bubble, I think the bubble is being built up in government debt. And I think that when this bubble bursts, you're going to see all that money that has gone into this government debt released from that. And what's going to happen is then potentially interest rates are going to rise dramatically, and that's going to have a negative effect on housing, on business investment, and people's ability to take out loans. And so we have got to stop the borrowing. We have got to stop the spending. If we don't do this, we are on a road to financial bankruptcy led by Washington, D.C. and the politicians who run this town.
All right, Steve Moore, senior economics writer at the Wall Street Journal. Thanks so much for joining us. We appreciate all of your insight.
Thank you so much for having me.